Welcome back to the Pro Ticker Podcast, your Thursday morning edition covering major financial magazine headlines, everyone. Today, we're diving deep into a market that feels like it's pulling in two completely different directions. We're looking at reports from Bloomberg and CNBC, both dated today, October 2nd. And our mission really is to make sense of this dissonance. You've got this massive, almost frantic AI boom driving tech valuations sky high. But then right here in the U.S., you have total institutional chaos with the government shutdown. So how do these things even coexist? And, what should you actually be paying attention to?
It's fascinating, isn't it? Because right now, global money seems much more interested in that tech enthusiasm than the political mess here. Let's start with AI, the big number this week. OpenAI. They just closed a secondary share sale, pulled in $6.6 billion, and that locks in their valuation at, get this, $500 billion. $500 billion.
Wow. $500 billion. Just put that in perspective for us.
Well, Bloomberg confirmed it. That officially pushes them past SpaceX. SpaceX is sitting around $456 billion now. So
yeah.
Big leaks.
Incredible. And the source material mentioned something interesting about the sale itself, right? The amount raised was less than what they'd authorized.
Exactly. That's the kind of detail you look for. They authorized selling up to $10.3 billion in shares. But only about 2/3 of that, the $6.6 billion, actually got sold.
So normally you might think that's weak demand.
You might, but apparently inside OpenAI, they see it differently. It's actually being seen as a sign of employee confidence. The thinking is employees are choosing not to sell all their private shares now. They're holding back.
Because they expect a bigger payday later. Like with an IPO.
Precisely. They're betting the company's value will climb much higher, so they're holding on to those illiquid shares. It's a classic high-risk, high-reward bet you see in, these hyper-growth private tech firms.
And that optimism, that demand, it's rippling outwards, right?
Yeah.
Fueling this huge infrastructure build-out globally.
Oh, absolutely. Look at South Korea. Their chip makers are just soaring. News came out about an expanded partnership with OpenAI, the Stargate initiative. The whole point is to ramp up the supply of advanced memory chips.
And the market reaction was immediate.
Instantaneous and huge. SK Hynix, they're a key supplier to NVIDIA. Remember, their stock jumped nearly 10%. That's a 25-year high for them. We haven't seen levels like that since year 2000.
Wow.
And Samsung Electronics. Also up significantly, about 3.5%, their highest since early 2021. It's all about boosting production of high-bandwidth memory, HBM.
Okay, HBM. Why is that specific type so critical?
Because it's the ultra-fast memory you need to train these enormous, power-hungry AI models. SK Hynix is apparently ready to mass-produce the next generation, HBM4, and that's expected to be absolutely essential for NVIDIA's next big thing, their upcoming Rubin architecture. So the market is basically pricing in guaranteed future demand. They're buying the picks and shovels for the AI gold rush.
It's creating some strange bedfellows too, isn't it, on the competition front?
You could say that. This is really interesting. CNBC reported that Intel is in early talks with AMD, their biggest rival for decades.
About what? Manufacturing?
Yeah, about potentially using Intel's foundries to make AMD chips.
That's huge. What does that signal?
It signals the sheer scale of the demand. The chip supply crunch is so intense, even bitter rivals might have to cooperate just to get enough capacity online. And investors notice Intel stock jumped 7% on that news. It's a real vote of confidence in their CEO, Lip-Bu and his whole turnaround strategy to make Intel a major foundry player again.
But the geopolitical tensions haven't just vanished. What about Taiwan?
Right. Still a major factor. Taiwan currently supplies something like 95% of the high-end chips the U.S. needs. It's their silicon shield, as people call it. And they just flat out rejected this idea floated by the U.S. Commerce Secretary for a 50-50 split in production.
So no deal there.
Nope. Taiwan's top trade negotiator basically said, look, we talked about tariffs, yes, but we are not talking about giving up our dominance in semiconductor manufacturing. That's off the table.
Okay, so beyond the chip makers, where else is this AI money flowing? You mentioned an ecosystem effect.
Yeah, look at Alibaba. Their Hong Kong shares surged 53% just in September. 53%. Best performer on the Hang Seng Index.
And that was tied to AI spending.
Directly. They announced plans to significantly hike their AI investments. That prompted JP Morgan to jack up their price target for Alibaba by almost 45%, looking out to the end of 2026. It shows this AI arms race is forcing huge strategic shifts everywhere.
It's not just the established players either. We saw a big IPO this week related to AI infrastructure, right?
That's right. Rick Perry's company, Fermi, it's an energy REIT, basically focused on providing power infrastructure for AI data centers. launched on NASDAQ, $15 billion valuation right out of the gate. And the stock closed up 54% on day one.
54% on day one. That's incredible investor appetite.
It is. But here's the really wild part, according to the source material. Fermi doesn't expect to have any tenant revenue until 2027.
Wait, what? No revenue for over 2 years?
Nope. That's not just enthusiasm, that's pure FOMO, fear of missing out. Investors are throwing billions at future capacity, basically betting that the AI revolution is so inevitable that 2 years with zero income is, like, not even a concern.
That's a leap of faith. Meanwhile, inside the big tech companies, they're making some hard choices.
Brutal choices. Google, for instance. They laid off over 100 people in design roles within their cloud unit. It's part of a wider effort to cut costs elsewhere and just pour resources into AI. It shows it's not just about adding AI on top, it's becoming a zero-sum game internally. Resources are being forcibly shifted.
Okay, let's use that shifting of resources as our pivot. We go from this extreme tech optimism to the complete opposite. Institutional chaos here with the U.S. government shutdown. It's a paradox, right? The government basically stops working, but the S&P 500 hits a new record, closing above 6,700 for the first time yesterday, up 0.34%. How does that make sense?
Well, it's strange, but maybe predictable. The sources talk about investors being almost anesthetized to this kind of DC drama.
Seen it before, basically.
Exactly. History shows shutdowns tend to be short-term noise for the market. Bank of America crunched the numbers. The S&P 500 actually tends to rise about 1% on average in the week before and after a shutdown starts. So the market's betting this won't last long. Prediction markets are pointing to maybe almost 2 weeks. And investors are focusing on what they think really matters. Corporate earnings, especially tech and AI, and of course the Fed.
But the shutdown is creating problems for the Fed, isn't it?
Yeah.
With economic data.
That's the real risk here. The shutdown injects uncertainty precisely where the Fed needs clarity. We already saw the ADP jobs report come in weak.
Right, you mentioned that earlier. Payrolls declined.
Yeah, private payrolls fell by 32,000 in September. The estimate was for a gain of 45,000. So that weak number immediately fueled bets the Fed might have to cut rates, maybe as soon as this October meeting.
But the official numbers are delayed.
Correct. The really crucial one, the official non-farm payrolls report that was due out Friday. But because of the shutdown, it's delayed indefinitely. So the Fed meets later this month, and they could be making a major decision on interest rates while, as analysts put it, flying blind. They won't have the key labor market data. That's a genuine risk.
And beyond just the data blackout, the political sources suggest the administration is actually, well, using the shutdown.
It appears so. Reporting impartially on what the sources say, you see moves like the Office of Management and Budget Director Russell Vought freezing $18 billion in infrastructure funding for New York City, and also canceling nearly $8 billion in green energy funding, mostly targeted at states run by Democrats.
So using it as leverage for budget cuts.
Seems that way. And they're also using the downtime to push ahead on other things, continuing investigations for potential future tariffs, Section 232 stuff on pharmaceuticals, heavy trucks, plus moving forward with that big $20 billion currency swap bailout for Argentina.
Have they followed through on threats of layoffs?
They've threatened mass layoffs and permanent program cuts. Analysts say that would definitely hurt the economy long term, but they also think there would be significant legal challenges to doing that. So maybe more threat than reality right now.
Okay, now connect the dots for us. How do these federal budget cuts ripple out into, say, the real estate market? There was an interesting angle there.
Yes, this is the aha moment, I think. It comes down to government leases. This agency, the Department of Government Efficiency, or DOGE, they've canceled 384 government leases.
To save money, presumably.
Yeah, the estimated savings are around $140 million, but the impact goes way beyond that $140 million because the government, well, they're the perfect tenant, right?
Rock solid. Always pay the rent.
Exactly. They're the ultimate anchor tenant. Perfect credit rating, provides huge stability for building owners, and crucially for the banks that lend money to those owners. When you suddenly pull that anchor tenant out, it destabilizes the whole commercial lending market tied to those properties.
And this affects those bundled loans we hear about, CMBS.
Precisely. CMBS, commercial mortgage-backed securities. Thousands of loans on these commercial properties are bundled up and sold to investors. When the reliable government tenant disappears, the perceived risk of those underlying properties just skyrockets. That can lead to defaults, and it seriously threatens the value of those CMBS bonds held by investors all over the world.
Is the pain spread evenly?
No, not at all.
Yeah.
The sources highlight that rural areas, less populated counties, are hit hardest. About 57% of the leases eligible for termination are outside the top 10 most populated states and D.C.
What does that matter?
Because in those smaller markets, there are far fewer options to replace the federal government as a tenant. So the local economic hit is much, much worse. It's a real problem brewing under the surface.
Okay, let's shift gears dramatically. Let's talk China, specifically the electric vehicle market. Seen some divergence there, I understand?
Yeah, quite a bit. BYD, the undisputed market leader, actually posted its first year-over-year decline in deliveries for 2025. September deliveries were down almost 6% compared to last year.
6% down for the leader. That must raise some eyebrows.
It does. It definitely reinforces those worries about a slowdown, especially with the fierce price war going on over there. I mean, BYD still dominates, don't get me wrong, they have over 54% market share, but still a year-on-year decline is notable.
But it's not the whole story.
Yeah.
Other players are doing well.
That's the key. While BYD stumbled slightly, the smaller upstart competitors are absolutely surging. It shows the market is fragmenting fast. Price cuts and cheaper new models are shaking things up. We saw multiple smaller EV makers set new monthly delivery records in September.
Like who? Give us some examples.
Okay, so Leapmotor deliveries were up over 97% compared to last year. 97%. They're hitting that lower price point. Xpeng also had a great month, up 95% year over year, breaking 40,000 deliveries. NIO set another record high for the second month straight. And Xiaomi, the phone maker, they also hit a new milestone, over 40,000 EVs delivered.
Wow, so lots of movement below the surface.
Tons. Even Li Auto bounced back after a couple of slower months. It just shows the competition is incredibly intense. It's all about hitting the right price point and offering something new that maybe BYD isn't capturing right now. Local consumer demand is driving this churn.
Okay, one last area to touch on. Amidst all this tech frenzy and political anxiety, what's happening with the traditional safe haven, gold?
Gold is actually doing quite well. It's on a 5-day rally, trading up near $3,875 an ounce.
And what's driving that? Is it the shutdown? The Fed uncertainty?
Both, really. It's a direct consequence of the chaos we've been discussing, that weak ADP jobs report. It boosted bets on Fed rate cuts, which tends to weaken the dollar. Gold likes a weaker dollar. And then, the U.S. government shutdown just adds to the general feeling of fiscal worry, puts more pressure on the dollar. So gold is basically pricing in a weaker dollar and higher overall risk.
Are the big institutions buying into this gold rally?
Very much so. Goldman Sachs is apparently quite bullish. They see a large upside risk to their current gold forecasts, partly because they're seeing surprisingly strong buying from private investors.
What are their actual forecasts?
According to Bloomberg, Goldman is looking for $4,000 an ounce by mid-2026 and then $4,300 an ounce by the end of next year.
So they see this as more than just a temporary blip.
It seems so. They're pointing to things like continued central bank buying and expected shifts in monetary policy globally as longer-term drivers. They think it's potentially a more structural shift in how big money views risk, not just short-term noise.
Okay, so let's try to wrap this all up. We've covered a lot. What's the big takeaway for you, the listener, from all this? It really feels like we're living in two separate realities, doesn't it? You've got this AI boom pushing tech valuations to, frankly, astonishing levels. I mean, a company with no revenue for 2 years debuting at $15 billion. And that tech excitement seems to be completely overshadowing the political chaos here in the U.S., which, even if the broad market ignores it, is causing very real specific pain points like messing with economic data and destabilizing parts of the commercial real estate market through that CMBS ripple effect.
Right. And maybe the provocative thought to leave you with is this. Think about the justification for this AI bull run. So far, it's been almost entirely driven by massive spending on the hardware, the infrastructure, the chips, the data centers. That's pushed the main semiconductor index, the SOX, to trade at a really high multiple, like 27 times earnings. The huge question hanging over the market now is, will the actual AI services generate the kind of mainstream profitable revenue needed to justify those massive chip valuations? Or will the fear of missing out finally collide with a cold dose of reality when we see the Q4 earnings reports? That feels like the potential reality check ahead.
It really does. That's the big question the market needs to answer. Okay, that's all the time we have for this deep dive, and we'll see you all tomorrow morning with new headlines from major financial magazines.